Hey everyone, it's your friend Daniel. Welcome back to the channel. If you're new here, consider hitting that subscribe button and joining our awesome community of future millionaires. Today, we're diving headfirst into the world of investing. Don't worry if you're a complete beginner. This video is tailored just for you. We'll break down complex concepts into bite-sized pieces and equip you with the knowledge to start growing your wealth. Remember, investing is a journey, not a sprint. So, buckle up, grab your favorite notepad, and let's embark on this exciting adventure together. Before we even talk about stocks, bonds, or any fancy financial instruments, we need to ensure you have a rock-solid foundation. That means addressing the essentials: your emergency fund, high-interest debt, and financial goals. First things first, an emergency fund is non-negotiable. It's your financial safety net, your peace of mind. Aim for 3 to 6 months' worth of living expenses tucked away in a readily accessible account. This ensures you won't be forced to make rash financial decisions if life throws you a curveball. Next up, let's tackle those pesky high-interest debts like credit cards. They can eat away at your hard-earned money faster than you can say compound interest. Create a debt repayment plan, prioritize the ones with the highest interest rates, and chip away at them systematically. Now, let's talk about your why, your financial goals. What are you saving and investing for? A down payment on your dream home? Early retirement? A world cruise? Defining your goals will not only motivate you, but also guide your investment strategy. Short-term goals might require more conservative investments, while long-term goals can tolerate a bit more risk. All right, now that we've got the basics covered, let's talk about risk tolerance. In simple terms, it's how comfortable you are with the possibility of your investments going up or down in value. Imagine this: you have $1,000 to invest. Would you rather put it in a low-risk investment that might earn you a steady 3% per year? Or would you be willing to take on more risk for the potential to earn 10% or even higher returns? There's no right or wrong answer here. Your risk tolerance is as personal as your fingerprint. It depends on your financial situation, your time horizon, and your emotional capacity to handle market fluctuations. Generally, younger investors with a longer time horizon can afford to take on more risk, while those closer to retirement might prefer more conservative investments. But remember, it's all about finding what aligns with your comfort level. Take some time to assess your risk tolerance honestly. There are even online questionnaires that can help you with this. Understanding your risk appetite will be crucial when we start exploring different investment options later on. Let's talk about eggs and baskets. You've probably heard the saying, "Don't put all your eggs in one basket." Well, the same principle applies to investing. It's called diversification. Diversification means spreading your investments across different asset classes, such as stocks, bonds, real estate, and commodities. Why is this so important? Because different asset classes tend to perform differently under various market conditions. When one asset class is down, another might be up, balancing out your overall portfolio and reducing your overall risk. It's like having a financial safety net. Think of it like this: if you invest all your money in a single company and that company goes bankrupt, you could lose everything. But if you diversify your portfolio across different companies, industries, and asset classes, you're less likely to be wiped out by a single event. Diversification won't necessarily guarantee you'll make the most money, but it will help you sleep better at night knowing your investments are well spread. Remember, in investing, slow and steady often wins the race. Now, let's get down to the nitty-gritty of where to invest your money. As a beginner, I highly recommend considering low-cost index funds and ETFs, or exchange-traded funds. Think of index funds and ETFs like baskets of stocks or bonds that track a particular market index, such as the S&P 500 or the Dow Jones Industrial Average. When you invest in an index fund or ETF, you're essentially buying a tiny piece of all the companies included in that index. What makes them particularly attractive for beginners is their low costs and built-in diversification. They're like the autopilot of the investing world, providing you with broad market exposure without the need for extensive research or stock picking. There are countless index funds and ETFs available, catering to various sectors, industries, and investment strategies. Do your research, compare expense ratios, which are the annual fees charged by the fund, and choose funds that align with your financial goals and risk tolerance. Now, let's talk about a powerful investment strategy that can help you navigate the ups and downs of the market: dollar cost averaging. Imagine this. You have $12,000 to invest, and you're not sure whether to invest it all at once or spread it out over time. Dollar cost averaging suggests the latter. Instead of investing the entire lump sum, you divide it into smaller amounts and invest them at regular intervals, say $1,000 every month for the next year. This way, you're buying more shares when the market is down and fewer shares when the market is up, potentially lowering your average cost per share over time. Dollar cost averaging doesn't guarantee you'll buy at the absolute bottom or sell at the absolute top, but it can help you reduce the impact of market volatility on your portfolio and potentially enhance your long-term returns. Remember, investing is a marathon, not a sprint. Patience and consistency are key. We've covered a lot of ground today, from building a solid financial foundation to exploring different investment strategies. But if there's one golden rule to remember, it's this: stay invested for the long term. The stock market is like a roller coaster. It has its ups and downs. There will be times when your portfolio is soaring, and there will be times when it's taking a dip. The worst thing you can do is panic and sell everything when the market is down. Remember, short-term fluctuations are normal. What matters most is your long-term investment horizon. History has shown that over the long run, the stock market tends to go up. By staying invested and riding out the bumps along the way, you're giving your investments the opportunity to grow and compound over time. So stay focused on your goals, tune out the noise, and remember that patience is a virtue when it comes to investing. We've covered the essential steps to kickstart your investment journey. Remember to prioritize an emergency fund, eliminate high-interest debts, and define your financial goals. Then you can begin exploring the world of investing, starting with understanding your risk tolerance and the importance of diversification. If you're eager to learn more about specific investment strategies, different asset classes, or anything else related to building wealth, be sure to subscribe to the channel and hit that notification bell. We've got a ton of exciting content coming your way. Thanks for joining me today. Until next time, happy investing.